Welcome back. It's now time for Forum Daily's weekly energy update with Dan McTeague, Senior Petroleum Analyst at GasWizard.ca. Take it away, Dan.
Well, hello, and thank you again, Nima. What a week we've seen here on the energy front right across the country. Obviously, gasoline is the big deal, but there's a lot of movement, obviously, on other forms of energy related to gasoline, related to diesel, natural gas, the Nord Stream disruptions, sabotage. Word is now, of course, there's maybe 4 events on both lines. That hasn't had any real impact yet on energy prices, surprisingly so, because it basically leaves Europe extraordinarily vulnerable. And it looks like market traders who seem to be practicing the obsession with recession aren't seeing the forest for the trees. And so you get circumstances like we saw across Canada, where prices now, as I predicted last week, would start to move up dramatically so in the case of Vancouver, which I thought would start to see prices going down. But instead, we're seeing an example of what happens when you cut off pipelines. You don't allow enough energy to get into your own backyard. You regulate industries. You create a scenario, not just obviously in British Columbia or in Canada, but in the United States and the West Coast, particularly California, where you have boutique gasoline that no one else can produce. And so when refineries have upsets or go through planned maintenance, demand remains robust. The supply just isn't there. And so we've seen a spike in Vancouver to levels never seen before of any city anywhere in North America. $2.42 a liter today. It may come down a little bit this week. I believe it will. But that works out to about $6.80 US a gallon if I'm using an exchange rate of $1.37.1, $1.37.2. So it looks like reaching new highs isn't simply the function of oil prices. It has a lot to do with local economics on gasoline. And that, I think, sets the stage for what we're going to see for the rest of the country and for the rest of the season. Winter is coming. Demand for oil will increase. Remember, for all those who thought it was cute that the Biden administration deliberately used its strategic petroleum reserve to somehow bring down prices, which to some extent worked, you still have to replace it. And you're not replacing it at what you bought it for, $30, $40, and $50 a barrel. You're replacing it at $80, $90, and $100 a barrel. So that's going to be on the American taxpayer, and it's ultimately going to be reflected in the fact that in an era where there is so limited supply, or supply has been severely challenged over the years by underinvestment and, of course, higher demand post-COVID, those two factors alone are likely to lead to a very surprising and very painful outcome for Canadians as they appear by some to be heading to a recession. That aside, I would expect that British Columbia's prices are going to remain where they are, elevated in the interior, 185 plus. Vancouver could see about a 10-cent decrease as refineries get back up and running. For Saskatchewan, Manitoba, and Alberta, you've already seen the 20 and 30-cent increase. We're likely to see that come down maybe 3 or 4 cents a liter, but not much more than that. That's a function of what's happening in the U.S. Midwest, something called PAD 3, where a refinery had gone down, has come back up since. That is the BP plant in Whitting, Indiana. And of course, right after that, the other BP plant in Toledo, Ohio, which didn't just blow up. It's not likely to be repaired anytime soon. So that's going to leave the U.S. Midwest market chronically short of fuel as we go through winter, especially diesel. That's obviously going to have a direct impact on Canadian Midwest prices or prairie prices. For Ontario, look for about a 4 cent up and down. So we're 156.5, it's 160.56.9, dropping down to about $1.53. Maybe $1.52 by this time next week. Same for Quebec. Look for about an average up and down of 4 cents a liter, staying in the 165, 170 range. For the Maritimes, you're looking at the same scenario. It follows the Eastern Canadian pattern, which of course is based on the New York Harbor spot price for gasoline, which is really in a bit of a turf war, if you will, or a tug of war. But that really means that all eyes will be focused next Wednesday on what OPEC does. It is clear that they are going to cut 500,000 to perhaps 1 million barrels of production a day on paper. Whether they do that or not is a different matter. There are many that suggest that they haven't actually lived up to their commitment to increase production over the past several months. That aside, those traders out there that are obsessed with recessions and Chinese demand and whatnot are finally going to have to face a reality of a market that is critically undersupplied when it comes to the very things that we need as we're heading into colder weather. That's oil, that's diesel, that's jet fuel, heating fuel, furnace oil, and of course, bringing gasoline on for the ride. Well, look, Nima, that's it for this week. I'll have more good news perhaps next week. But for now, brace for impact. Things are going to get a lot more expensive in the future.
Always lots to consider. Thanks again for that, Dan. Again, that was Dan McTeague, Senior Petroleum Analyst at GasWizard.ca. He is also the president of Canadians for Affordable Energy.